how TLT was pushed down by the unreal jobs report, creating an illusion for the Fed to keep raising rates into a cliff of deflation crash. Last year, there were 159,000 total high-paying job cuts from big tech. This year, just in January, we already have Amazon, Google, Microsoft, Salesforce, IBM, Goldman Sachs, and 3M, etc., cutting a total of 63,000 high-profile jobs. Poof, gone. Somehow, unemployment rate went lower. It seems the more jobs people lose, the more the government will lower unemployment rate. This non-farm payroll report from BLS is completely BS. For the reason the world's smartest businesses are laying off folks is because they know the economy is weak. Evidence is showing in Apple and Google's double miss in earnings and sales. So why is the bond market sold off on Friday? Is it because of the Phillips curve? What's Phillips curve? How TLT was pushed down by the BS jobs report, creating an illusion for the Fed to keep on raising rates. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get it into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? Phillips curve is a theory that inflation and unemployment have a stable and inverse relationship. Thus, when we just got the lowest unemployment rate in over 50 years, we are still having an inflation problem that the Fed has to solve. By now, you already know that jobs report was likely cooked. But the bond market is still reacted negatively. Here is what the Fed wants you to believe and why TLT was sold off. Fresh signs of a hot U.S. labor market leave the Federal Reserve on course to raise interest rates by a 1/4 percentage point at its meeting next month, and to signal another increase is likely to happen after that. The Fed voted Wednesday to raise its benchmark federal funds rate by a 1/4 percentage point to a range between 4.5% to 4.75%. The central bank is seeking to slow average pace to weaken demand and restrain inflation, which has eased recently after hitting a 40-year high last year. Employers added a robust 517,000 jobs last month, and the unemployment rate fell to 3.4%, the lowest level since 1969. The Labor Department said Friday, average hourly earnings grew 4.4% in January from a year earlier. down from a revised 4.8% in December. The department not only reported unusually large job growth in January, but more important for the Fed, it revised previous months' reported gains higher, suggesting the economy had more momentum than previously anticipated. Wage growth also was revised higher in November and December. Hourly pay for private sector workers grew at an annualized rate of 4.6% during the 3 months through January, up from 4.1% for the prior 3-month period. Signs that the Fed's aggressive rate increases last year haven't significantly cooled the labor market could fuel more difficult debates at the central bank over whether it has done enough to curb high inflation. Bond investors and economists have anticipated that more evidence of a slowdown in investment, spending, and hiring could persuade the Fed to stop lifting rates after making another increase of its March 21st and 22nd meeting. But signs of any reacceleration could prompt officials to delay decisions about a pause into the summer. According to projections released after their policy meeting in December, most Fed officials thought the central bank would need to raise the Fed funds rate to 5.1% this year, which would imply quarter-point rate increases at their next 2 meetings, in March and May. More than a third of officials, however, anticipated lifting the rate above 5.25%, which would call for another increase in June. When asked at a news conference on Wednesday about any pause, Fed Chair Jerome Powell said, "I don't feel a lot of certainty about where that will be. It could certainly be higher than the December projection. If we come to the view that we need to move rates up beyond what we said in December, we could certainly do that," he said. The job gains reported Friday could unsettle Fed officials if other reports in coming weeks also point to stronger economic growth. Officials will see one more employment report before their March meeting. Consumer demand and inflation could very well accelerate at the start of the year, after cooling in late 2022. This is what the Fed was attempting to avoid, said Diane, chief economist at KPMG. Such a dynamic would force the Fed to raise the Fed funds rate to at least 5.25% in 2023 and hold it there through the year, she said. Fed officials could face a fork in the road when forecasting inflation in the months ahead. They could focus on moderating price trends that suggest wage growth could eventually slow, especially after an initial inflation surge that could have prompted workers to demand more pay to keep up with the higher prices. Alternatively, they could conclude that still tight labor markets will boost workers' bargaining power and their overall incomes, providing fuel for inflation to reaccelerate after slowing. That could lead officials to conclude they will have to do more to slow the economy by raising rates higher or holding them higher for longer, or both. Policymakers have to worry about the next inflation problem, said chief U.S. economist at UBS. If the economy continues to add more than 200,000 jobs a month without a large increase in the supply of workers, whatever labor market tightness you have now would look worse in 6 months. Investors in recent weeks have anticipated that a sharp decline in inflation would prompt the Fed to cut rates this year. After any pause, it is equally as likely the Fed is raising rates again rather than cutting because the labor market bends but doesn't break, said Joe Davis, global chief economist at Vanguard, before the release of Friday's report. Overall inflation has been slowing largely because prices of energy and other goods are falling. Large increases in housing costs have slowed, but haven't yet filtered through to official price gauges. Even so, Mr. Powell has for the past 2 months justified continued interest rate increases by noting still tight labor markets, elevated wage pressures, and high inflation for labor-intensive services. The Fed is much more focused on underlying inflation. The mechanical unwinding of supply chain issues has been built into their forecasts, said Kristen Forbes, a professor at the Massachusetts Institute of Technology and former member of Bank of England's Monetary Policy Committee. The Fed is focused on the last mile, and so far, there has not been enough evidence of a slowdown that will get inflation down to 2%. Another reason why the bond market sold off on Friday is because of the futures yield from September of this year. We are now approaching 5% again. It shows we are likely going to be higher for longer. Check out these future yield charts. Instead of having 2 rate cuts, we might have only 1 rate cut. That's how the Fed is using BLS, creating an illusion to control the bond market and stock prices. But the fact is, the longer they keep the rate high in the sky, the harder and more painful the landing is going to be. Make sure to subscribe to the channel for this roller coaster ride with me. Thank you for all of my 480 Audacious subscribers. You are valued and appreciated here. A little change of the uploading schedule for the channel is going to take place. Since we are already over 100 plus videos created over 5 short months, I am cutting Tuesday off for more trading time. If you want to see every move that I am going to make in a trading week, please check out my Patreon link below. And this is my client collaboration book. It's already yours, Adversity Equals Success. Such an amazing book with such incredible authors. And my book, Rainbow Focus. You are such a good boy for watching my video right till the end. Bye.